Our dividend stock portfolio is still making market-busting gains, and the stock market is taking out fresh highs every day. So why am I selling stocks? I've uncovered 2 warning signs, 2 reasons to sell stocks right now, and you can't miss these if you want to protect your money. We're talking when to sell stocks today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now we are 4 months into our 2019 stock market challenge and the portfolio is still beating the market. As of last week, our portfolio of dividend stocks was up 23.6% against a 15.8% for the stock market and just 14% for the Vanguard Dividend Appreciation Fund. But the stock market rally has been insane, up 18% since the bottom on Christmas Eve, and that 85-day advance puts it within the top 2% of the strongest rally since 1928. Now, I've found some market signals that are flashing bright red, and we're moving into what has historically been one of the worst parts of the year for investors. The message is you have to be ready for what's coming. In this video, I'm going to first update you on our 2019 dividend portfolio, show you some of those changes I made to protect our profits. Then I'll reveal those market signals and why I'm selling stocks. I'm not saying there will be a stock market crash in 2019, but there doesn't have to be. The data I'm looking at is proof enough that you need to be protected. Now, I'm also going to talk about how you can invest if you're just joining us. Maybe you missed out on some of those portfolio gains but want to get started. So I'll reveal here what to buy now for protection and returns. Now, I'm putting this video into our 2019 Stock Market Challenge playlist, so if you haven't seen those other updates, check those out. Along with some of the biggest investing channels here on YouTube, I created a $1,000 portfolio in January, and I'm going to be tracking it all year long. To track my portfolio of dividend stocks, I'm investing $1,000 on M1 Finance, a no-fee platform that lets you pick your stocks and automatically invest any new deposits across that group. So here's our portfolio on M1 Finance, and it's tough to be anything but happy with an almost 24% gain in the first 4 months, especially compared to what the rest of the market is doing. The stocks pay an average 4.2% dividend yield, which is about double the market rate, and have provided that double-digit upside. Now, scrolling down, we see some of the real outperformers in this group. Hanes Brand continues to run with 67% return. ConAgra, which we just put on in March, is our second best return, and we have 5 stocks, almost half the portfolio, with returns of 35% or higher. Now, some of the laggards here are the funds like Vanguard Real Estate ETF, the iShares China Fund, and that iShares European Financial. It's intuitive that these aren't going to have those 30% plus returns because they're more diversified across hundreds of companies, but they give us that great exposure to larger themes without all the risks of a specific company. I still do like that China play, especially as we see more from recent stimulus measures by the government. Economic growth recently surprised to the upside with 6.4% growth in the first quarter, and I think these financial companies are going to benefit. The European financials have lagged, but there's still a lot of value there as well. Now, our investment in PPL Corporation has taken a hit on those Brexit uncertainties, but I think it could rebound again. Like I covered in our last month's update, that Alerian MLP fund is probably my favorite investment right now, and I think this could be one of the big surprises for the year. Oil prices are still fairly solid, and the yield difference between these MLPs and the U.S. Treasury yield is pointing to straight gains ahead. I did take some profits in some of those high-flying stocks this month to buy into those last 2 funds here, and we'll get into why I sold and why I picked these 2 funds. The first is this Vanguard Long-Term Bond Fund, ticker BLV. Now, this fund invests in corporate bonds and U.S. Treasuries and pays a strong 3.74% dividend. Just over 42% of the fund is in super safe government debt, with the rest right around that A and BBB credit rating, so companies with very strong financials. I also added a position in this Utility Select Sector Spider, ticker XLU, an ETF of 28 companies in the public utility space with a 3.1% dividend yield. Now, these are 2 safety plays. Not only are they funds, so they'll tend to be less risky than those individual stocks, but there are ideas that will tend to zig when the rest of the market zags. Now, that bond fund is the ultimate in anti-stock safety because these corporate debts are due whether the market rises or falls. The utility funds still invest in stocks, so there's that upside on growth, but these companies are typically more stable than others. And just look at what these 2 funds did late last year. From October through December, when the stock market tanked, falling 18.5% over the 3 months, the bond fund beat stocks by 21%, and even that utilities fund eked out a positive gain. That's not even including those dividends on the funds, which are both over 3% annually. So what I'm doing here, selling down some of our most profitable stocks and buying into these two funds, is that I'm buying protection. I've still got exposure to those stocks, but if the market tanks again, no matter how great the company is, the market's just going to drag it down with it. So I'm rebalancing into safer sectors like bonds and utilities. Now we're going to spend the rest of the video explaining why I think the market could be in trouble and the warning signs that I'm looking at. First though, I want to get your opinion. You know, half the reason why I started this channel was to reach out to the community and get your opinion. So what do you think? Is the stock market setting itself up for a crash, or do you think the bull market has room to run? Scroll down and let me know in the comments what you think and why. Now honestly, most of the economic data isn't that bad. Unemployment is still low and consumer spending is pretty strong. We saw a manufacturing report last week that said growth in U.S. factories was the slowest it's been since 2016, but it was still in that growth territory. Now the Chinese economy looks to be getting its footing back, and even global trade doesn't look too horrible. In fact, we see here in this table by the U.S. Bureau of Economic Analysis that even though this period of expansion, that 9.8 years of economic growth, is tied for the second longest going back to 1950, it still might have room to run. The thing we see here is that because the economy has been growing so slowly, just 2.3% a year on average, then the total economic growth over that period is just 25%. Hasn't been like some of these other wild runs we've seen. We're not worried that the economy has gotten too overheated that we should be worried about a crash. But the economy just isn't that great, right? You know, we're expecting just 2% or less for growth this year in the United States. And those warning signs that I'm going to talk about next really come from two sides: a forward outlook on where returns are going to come from, and by far the most accurate trading signal we've ever seen. For this first warning sign, let's look at a really simple explanation of stock returns, and I think you'll see where we run into trouble. Then I'm going to reveal that trading signal that we just hit. Now, over the last decade, the S&P 500 has returned 13.9% on an annual basis after inflation and including dividends. Now, if we look further into this, we had corporate profits growing at 5.5%, and that dividend yield averaged 2.1%. Now, that's a return of 7.6%, and top it off with the fact that the price to earnings ratio increased from 10.5 times to 18.5 times. So people were willing to pay a higher price for those earnings that increased. This change in the PE ratio accounts for that other 6.3% in real return after you adjust for inflation. Now these three factors, corporate earnings, dividends, and that price to earnings ratio, that's all you need to know where stocks are going. Stocks are in ownership of those earnings and the dividends, and then the PE ratio is just how much investors are willing to pay for it. Now look forward on these three factors and you quickly run into a dead end. Real corporate earnings growth has been on a tear lately, but just won't last. Earnings averaged just 1.9% over the last 150 years and is expected just 1.4% this year. Earnings are actually lower, so negative 2.3% in the first quarter versus last year. Wage inflation is starting to eat into profits, and that's going to be a big headwind on these corporate profits. So here we see the expected earnings growth for the year, with energy and materials companies expected to see huge decreases in their profits. Among the winners looks to be financials, consumer discretionary, and utility companies. Now understand this is with inflation, so not that real earnings growth. If we take this 3.6% estimate for earnings growth at S&P 500 companies and then take out that expected 2.2% inflation for the year, we get just 1.4% real earnings growth. So the dividend yield is fairly constant, but even that's down to 1.85% on the S&P 500. So even if we get that 1.4% real earnings growth and 1.85% on dividends, that brings expected returns on stocks to just 3.25% and leaves everything else to that price to earnings ratio. Unfortunately, we're not starting from a good place there either. At 18.5 times earnings, investors are already paying a lot for earnings, and this number rarely goes above 20 for long. In fact, the longer term average on that is closer to 15 or 16 times earnings, which would mean a contraction in that 3.25% return we get from that earnings and the dividends. Even if investors keep feeling good about stocks and we make it to that 20 times price to earnings ratio, that still only gets us to that 5% return on stocks. Now that's pretty close actually to a lot of estimates. BlackRock and BNY Mellon are both estimating stocks will return about 6% annually over the next 10 years. JP Morgan is estimating a little lower, closer to 5% annually, and again, these are returns including inflation, so that would be around 3 or 4% after inflation. So the message here isn't necessarily that I think stocks are heading for a crash, but the upside doesn't look that rosy either. The market is holding out its fist saying, pick one. In one hand, I've got a weak 5 or 6% return if everything goes well. In the other hand, I've got a repeat of last year and an 18% drop like we saw in December. So we're starting off from a disadvantage already. And top this off by the trading signal that we just ran into. Now, those of you in the community know I don't usually follow these trading signals or these short-term stock signals, but this one is eerily strong. I'm talking about the Sellin May phenomenon, sell in May and go away, also called the best 6-month strategy. Now, this strategy says to invest in stocks from November through April, then shift to a bond-heavy protected portfolio from May through October. Now, like I said, I generally hate these simple trading strategies. Everyone in the market knows about these, so they shouldn't work. But that sell in May continues to confound investors and really is one you want to pay attention to. It's been a little off for the last few years. Stocks have been up in 5 of the last 6 years during that May through October period, but this remains one of the best strategies ever for predicting returns. An investor putting $10,000 in a portfolio of S&P 500 stocks between May and October from 1950 to 2018 would have lost more than half his money. As crazy as that sounds, the portfolio would have lost $5,862 of that initial portfolio invested in those 6 months over those 68 years. Now, conversely, an investor putting that $10,000 in the same S&P 500 portfolio over that same 68 years, but during the November through April period, would have grown it by over $2,836,000. Now, that's not a typo. There is a $2.8 million difference investing during the best 6 months versus the worst 6 months. Now, as simple as it may sound, the Sellin May strategy does work to protect your money and even grow it. And it's not all by chance, though. There is some intuitive reasoning why this happens. Investors and traders would rather be on the golf course or at the beach during those summer months, and trading volume plunges. Now, this tends to amplify those large swings in the market, especially to the downside. September and October are often down because of profit taking by portfolio managers and mutual funds. When you do get to those last 2 months of the year, a lot of those year-end trading strategies tend to boost stocks, with institutional investors jumping back into the market and then bidding up those stocks. You get year-end bonuses coming into the market, and consumer spending can put a positive spin on the economy. Finally, you get to January and the new year positivity that hits investors. So combining that headwind from those 3 factors, corporate earnings, dividends, and the PE ratio, with that sell-in May phenomenon, I'm pulling back a little in our 2019 dividend portfolio. I took profits in a few of the high flyers and put it in that utility fund and the bond fund. Now, I know most of you have a longer-term focus on your investments, and anyone with more than 15 years left to their goals, you really don't have to worry too much about a stock market crash or recessions. You're going to be investing through lots of these market hiccups, and you're going to have lots of time to see your stocks rebound. Even if you've got that longer-term investing strategy and you don't want to sell stocks, you still need to protect the money you've made. So maybe sell in May isn't quite the words I want to use, but definitely reposition in May. Checking back on your investments in stocks, bonds, and real estate through those real estate investment trusts, and making sure you have enough investments in each, spread out across all 3 assets. For a lot of people, their stock gains have zoomed ahead in these assets, so it's time to sell stocks, take some of those profits, and put money back in bonds and real estate. You should be doing the same thing for these sectors within your stock portfolio. So here we see the 5-year returns on the 11 sectors and the S&P 500. We see that while the stock market has done really well with a 55% total return, sectors like consumer discretionary and technology have boomed with an 85% and an 115% gain over that period, while sectors like energy, materials, and communications have lagged. So you don't even need to sell out of all your stocks to do this repositioning out of the expensive sectors and into those value ones. You can take profits in some of your tech stocks or consumer discretionary and maybe look for those value names in the lagging sectors. I'm not talking about trying to time the market here or even saying that you can totally avoid a stock market crash. What I'm saying, and this is important for those of you just joining us that maybe missed out on when we started the dividend challenge in January, you can still do really well this year if you reposition for safety and value. So look to some of those bond and real estate investments like the Vanguard Real Estate Fund, that ticker VNQ, or the bond fund that we added to the portfolio. Look to some of the stocks in the portfolio that have lagged a little but still have lots of value, like the Alarian MLP fund and some of those other funds. I'm linking directly below the video to the first videos detailing how I set up our dividend income portfolio and how you can set up your own challenge. I'll also leave a link to M1 Finance, that no-cost investment platform that I'm using for the challenge that's going to save you all those fees whenever you rebalance your money. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments below. We'll make sure you get an answer in a future video.